This episode of Macro Mondays aired live at 12:30 p.m. on Monday, the 6th of January, 2025. Tune in Mondays at 12:30 p.m. UK time to watch Macro Mondays live.
Hello, welcome to the first Macro Mondays of 2025. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd, Direct Trader here at Onyx Commodities, looking to give you insight from our trading floor.
Today we'll be discussing key market trends, risks and charts. We'll start with the US dollar, which has started the year very strong, although the last hour we're starting to see some aggressive weakness. And we'll look at Chinese yields as well, which continue to trend lower despite certain signals of strength in the economy.
We'll discuss commodities as well, as it's been a strong start to the year in oil, and we'll also be looking ahead of Friday's key payroll data coming out of the US.
If we start with the US data, we just had last week December ISM Manufacturing Index. This rose to 49.3, higher than expected to 48.2. Now, on one side, you could say, well, the data's better than expected, but it's still in contraction. In fact, manufacturing in the US in contraction for the 9th consecutive month. Prices paid and new orders both rose. New orders is good. Prices paid, of course, is not so good, especially for the Fed and their concerns around inflation. Perhaps most concerning is employment slowed sharply. Of course, this Friday, we have the big payrolls data, probably the biggest data we see economically, globally. So that's a poor start for the year. If we look at global manufacturing PMIs, the momentum's actually very poor. They fell back in contraction at the end of 2024, and they have declined for the last 5 of the last 6 months. So global manufacturing continues to be weak. The ISM service sector has beaten expectations. And what we've seen to start the year is more dollar strength, with the dollar index going above 109. We discussed, is this a major risk for 2025? The euro dollar is now its lowest in over 2 years, trading around 104 at the moment, heading towards parity. Dollar CNY Chinese yuan has broken above 730. We have a chart later on that. The PBoC in China have allowed the currency to weaken, which will concern Trump and the new regime in the US. And we're seeing dollar Brazilian real weaken, Indian rupee at all-time lows again. So there's certainly going to be concerns around dollar strength going forward.
Yeah, I think just to bring it back to the PMI headline quickly. So for those that aren't familiar with PMIs, it's a rolling average. And so if you were to see anything below 50, that shows that you're in contraction, as you said. And with the previous month being at 48.4, I think it was revised to, you're seeing a decline in US manufacturing. And so even if it were to have reached 50, that would be sort of less manufacturing than would have been the case on the month prior. That's just how a rolling average works. So yeah, to see the US PMIs fail to meet 50, it's not overly surprising given the context of how manufacturing anecdotally has been in the US, but in terms of the impact upon other markets, like the US dollar against foreign currencies, I think that's why it's crucial to point out that PMIs worldwide, globally, have been falling, because if the US PMIs are simply falling, but everything else is increasing and manufacturing worldwide really takes off, then you have trade imbalances, etc. But in the context of everything being slightly weaker, I think that's good context in terms of studying the US dollar's strength at the start of this year.
Yeah. Also shows obviously the concerns about global growth.
Yeah.
With manufacturing continue to weaken. We talk about dollar strength. What's happened in the last hour? We've seen headlines out from the Washington Post that Trump aides are exploring tariff plans for every country and only critical imports. But what we've seen there is we've seen some yields falling and the dollar's been hit on this, but that's certainly a concern that's throwing some risks into the market. But with dollar strength, certainly against emerging market currencies, we've mentioned India, we've mentioned Brazil, that has to be concerns. If we look back at 97, the Asia crisis due to dollar strength, if we continue to see dollar moving higher in the medium term, then there'll be certain risks to the global economy. If we move on to US equities, the equity market is starting the year extremely strong. S&P 500 PE multiples at 22.5 times. That's only been higher twice in history, in 1999 dot-com bubble and with all the stimulus that came out in 2021 on the back of COVID. What we're seeing now is the S&P's price to book ratio is now a highest of all time, above March 2000. So equities, well, if they're trending higher, they are expensive. There's no doubt they're expensive. If we move on to the next chart, you can actually see the S&P, how it's performing. And you can see there's a key support, 5,830. Of course, it's going to be interesting to see how we start the year, if we see more buying, and also how the market reacts to Donald Trump's inauguration.
Yeah, I think obviously US equities in particular were one of the great performers of 2024. And to see them performing, starting the year relatively strong will be good news for a lot of punters. But it's worth noting that around the 18th of December, that week just before Christmas, there was actually quite a lot of selling. This was then met with rebounded buying, but we've settled slightly lower than where we were on the 18th of December. And what we have seen is a spike in the VIX, the volatility index of the S&P 500. So even though the S&P 500 has started strong, there are clearly people that are, willing to take a bet against it at these high levels.
Yep, and if we focus more clearly on the chart again, you can see we've had a peak, we're now having lower highs, but we're in consistent lows at this 5,830 level. Why that becomes so critical, if the market closes below there, we have not only lower highs, but also lower lows, and the market's clearly then in a downtrend. All the people want to buy and hold, whatever the feelings. If we get a close below 5,830, then the market's in a downtrend. You will see CTAs, trend following algorithms starting to unwind positions. You'll see technical traders unwinding positions. And that then becomes a risk because the market's expensive and the positioning is still crowded. But while we trade above 5,830, then the longer term trend has to be higher. Another interesting development in the last couple of months has been the US yield curve. Whether you look at the 2s, 10s, which have traditionally been looked at, but also the 3-month against 10-year or 3-month against 30-year, all are steepening significantly. And actually that's historically always correlated with equity markets sell-off. Again, you could decide which leads which. Maybe it's equity markets historically have sold off first, which has caused the curve to steepen as central banks cut rates. But in this case, clearly the curve is steepening and again, historically equates with weaker equities.
Yeah, and I think it's also worth noting, one of the leading factors in terms of the angle of the bond curve of the yield curve is US debt and a lack of certainty over US debt long term. And so the headline that came out was that the US debt ceiling is being reinstated. So I believe US debt is currently sitting around $36.1 trillion or something. And the US is basically expected to meet the debt ceiling somewhere between the 14th of January and 23rd of January. This was according to Janet Yellen in her most recent letter. So crucially, you have Trump coming into office on, I think, January 20th, right in between these two. So it looks as though Trump's regime is going to be hamstrung by this US debt going forward. And that will, of course, lead to greater uncertainty in terms of long-term US economic development.
Of course, another point, as yields go higher, not only is it harder for the US Treasury, but also it means fiscal conditions are tightening, financial conditions, I should say. The bond market, the mortgage rates are getting higher. We're seeing mortgage demand falling. So the next Fed meeting, really, what does the Federal Reserve do? the market's not pricing a cut at the next meeting. In fact, the market's pricing less than 2 cuts for the rest of the cycle. But really, the Fed will probably want to sit on their hands and see how the market develops with the new president.
I saw something saying that Powell's not going to make any decision until at least March at the absolute earliest, because I think he wants to see how the new Trump regime goes and also what the global reaction to Trump's regime is.
Another interesting chart, the Citibank Economic Surprise Index, which highlights if economic data is coming in above or below expectations. Here we have it in the white line. Economic data starting to come in lower than expected. And I have it here correlated with the US 10-year yield. So it suggests that yields would expect to come lower as the economic data is coming in under expectations. But again, we do have a big data week culminating in Friday's payrolls. Moving on to China, the bond market is moving higher. Bonds are going higher, yields are moving lower. This is a sign of certainly distress within the economy. Despite some potentially positive economic signals, we had the Caixin Services PMI coming out over the weekend to a 7-month high. But the manufacturing PMIs slipped, came in last week 50.5, below estimations of 51.7. If I read out what it said the Caixin manufacturing PMI indicated a slowdown in both supply and demand growth for December 2024. The manufacturing production index and new orders index both fell to their lowest levels in 3 months. External demand weakened with the new export orders index returning to contraction territory. So we had the huge stimulus in September. Services sector is still showing strength, but manufacturing is really declining. But having said that, the market seems to be ignoring it. The currency is weakening, the equities are falling, and bond yields are making fairly concerning moves. The chart highlights the 10-year yield. The yellow circle highlights when you had the stimulus, the bazooka coming out in September. Yields jumped on expectations we'd see economic recovery. And then yields have, I don't want to say collapsed, that's a bit extreme, but yields have fallen aggressively. The 10-year yields are now below 160 and 2-year yields are sitting right on 1%.
Yeah, no, undeniably, very weak at the moment. And it's a worrying trend, isn't it? But I think another headline that, is important to put in there is we spoke briefly about the bazooka stimulus just now, and it seems as though Chinese government is going to maintain its level of intervention, and the Chinese treasury bonds are going to be reissued in 2025 in order to try and support trade-in programs and major projects. So this was all from the Reform Commission Deputy Secretary General Yuan. So it sounds as though China is going to maintain its attempts to keep this economy afloat, but a lot of these previous attempts over, second half of 2024 weren't head over heels successes. So I think, we can perhaps forecast a continued downtrend in things like yields.
Definitely. And with the currency weakening, the PBoC has let the currency break above 730. You can see they said actually they vowed to cut the RRR and interest rates at appropriate times, the reserve requirements. They also repeated the vow to keep one exchange rate basically stable. But you can see from the chart here, the key from the chart really, you can see where the currency strengthened against the dollar. Chinese yuan fell from September when we had the stimulus. But the really key point of this chart is the top right, the last 2 weeks, the last sort of 14, 15 trading days. You can see that they held the currency at 7.3, and then the last 2 days they've let the currency weaken. It's weakened fairly aggressively to 7.33, but that's going to upset the US administration. Back in June, Trump said that he was concerned about particularly China and Japan weakening their currencies, and again, it's going to heighten tensions when he comes into power. The Chinese equity market as well, the CSI 300 is breaking sitting right on support, 3,770. Again, you can clearly see when we had the stimulus in September, the market went up. At the peak, we had Goldman Sachs calling for the market to go long. We had David Tepper saying he was going all in. Well, this morning, the market's attempted to break the lows since the stimulus. It's sitting right on that key at 3,770 level. The problem if it breaks lower is all those longs are underwater. And what do you do? If you've taken on a big long position, it's trending lower.
You either defend or you stop out.
Or you cross your fingers and hope they come in with more stimulus.
Absolutely.
But it becomes a pain trade. And while we're on China, news came out over the weekend. BYD is now the world's second largest car maker. On the flip side, Tesla had its first fall in sales in over a decade. Tesla's shares plunged 4% as annual EV sales dropped for the first time in over a decade, selling 1.79 million vehicles last year, slightly less than it delivered in 2023. The Tesla chart here, you can see it's had a huge run up effectively since Donald Trump won the election. Elon Musk is working very closely with him, and we've seen quite an aggressive sell-off in the last few trading sessions.
Yeah, I mean, it's undeniable that EV demand has been rising worldwide over the past few years. And I suppose the question is, who's going to be the eminent provider of these cars? Now, I think a lot of people assumed that Tesla was so far ahead in terms of battery technology, etc., that they would be, at the forefront and perhaps even, couldn't be removed as the eminent electric vehicle company. BYD have seen that, they are just outperforming now. And to see Tesla's year-on-year sales not even increasing at all, but to actually decline in the context of BYD having this rapid growth, I think it's quite clear that a lot of people, from the stocks of Tesla and the stocks of BYD, a lot of people are assuming that BYD is going to be perhaps more the eminent car manufacturer in the electric vehicle age.
Yeah, what's staggering, as you said before, is the amount of electric vehicle development in China, not just BYD, but all the other dozens of other car companies every week coming out with new models. Onto Europe. ECB's not says a trade war could export China deflation to Europe. And we're seeing a strong divergence between US outlook and the outlook for Eurozone GDP this year. It's very rare that you see such a wide divergence actually play out. Typically, if there's growth in US, you see global growth. But clearly, I think the trend here is for euro dollar to keep going towards parity. We've said before, Eurozone seems mired in stagnation.
No, absolutely. I think the Eurozone, for a number of reasons, manufacturing seems poor. There seem to be, the tech industry that has been performing so well in the US just isn't doing that well in Europe at all. And it doesn't look as though things are going to change anytime soon.
And just red tape so restrictive on business.
Absolutely.
In the UK, we've seen weak mortgage approvals, the currency's weakening. Mortgage approvals fell to 65,700. That's 3,000 lower than expected. Quite a big miss there. The currency, you can see from the chart, the pound against the dollar, it's fallen from a high of 134. It's broken support and it's trending down. We've seen a bounce in the last hour, but again, that seems to be a clear trend. The UK economy appears to be weakening, starting to weaken now. And of course, there's, I wouldn't say a political crisis yet, but Elon Musk clearly turned on Keir Starmer, and Keir Starmer's not in a particularly favourable position at the moment.
Yeah, I think he's definitely coming under a huge amount of pressure, and not only just from Elon Musk, but from a lot of people within the UK. I think PBoC has made some requests for some more investigations into some of the ongoings over the past 10 years in the UK that Elon Musk has very much latched onto. Elon Musk, notably as well, has withdrawn his support for Nigel Farage and his leadership of the Reform UK party. But it does seem as though he's coming at loggerheads with one of the world's most influential men, and we shall see whether he, maintains his position, whether it be with the UK public or the court of public opinion that is X or Twitter.
Or the financial markets.
Yeah. And then, just to now talk about commodities. So we've had an interesting end of 2024 and start to 2025 in terms of Brent. So we actually saw a bit of an uptick. We've been in a relatively low volatility environment, and as you can see on the chart here, there's been a good amount of convergence over the long-dated sort of 4-year period with Brent, and it can't keep converging and go to zero volatility. It's oil. It's one of the most inherently volatile assets out there. But what we saw was an uptick, and so Brent rallied to close above $77 per barrel. So this, if we were going on the charts, would signal perhaps a breakout to the upside. In terms of the reasons why, well, there aren't any particular headlines that grab the attention too much. One of the headlines that came out was Joe Biden declared that they were preparing, before Trump came in, to permanently ban new offshore and gas developments in some of the US coastal waters. But whilst that does appear to be a bullish headline, it wasn't really met with much of an uptick at the time. I think a lot of people saw this as either an empty threat or something that was inactionable. So we have seen this price rally without a huge headline in the Middle East or in Russia. But what it is important to contextualize this with is the things that we've been seeing in terms of gas prices and also power prices. So if we look at the gas prices in Europe, so this will be just on the next chart that you're about to see. This is TTF, so this is Dutch, the Dutch benchmark for gas within Europe. And we saw a rise in TTF prices over the holiday period. And this was off the back of the major headline that Russia's Gazprom, that was currently supplying a lot of gas via pipelines through Ukraine to several European countries, these countries including Slovakia, Moldova, Hungary, but many others. They had lost their license to use those pipelines through Ukraine. Ukraine, saying that this money was being used to support the war against them, and in the context of the 5-year deal coming up on its renewal, they refused to renew it. So this has an impact upon gas prices throughout Europe, of course, because countries such as Slovakia, they're going to have to get their gas from somewhere, and they're going to have to get energy from somewhere, and so you see a trickle-down impact from an increase in gas prices due to a lack of supply of gas. That increases the upward price momentum on the major Northwest Europe gas benchmark, and also this will have an impact on oil, as oil can be used to produce power, etc., etc. And to talk briefly about power, we saw an uptick in the German power futures. So this graph shows here, yet again, for a similar timeline from the 15th of December onwards, we've just seen upward momentum in terms of power prices within Europe. Gas becomes more expensive. Oil has had a secondary impact, becoming more expensive. So, of course, power becomes more expensive. Now, the real impact of an increase in power price is pretty dramatic. Not only for your everyday consumer that has to, get energy to live their life and go about commuting or go about cooking, etc., etc., but this has a real impact upon manufacturing as well. So for a European market where manufacturing is already in an absolutely dire situation, I think any uptick in power prices will be not met with gleaming eyes. It's a worrying sign for manufacturing, and of course this has following on impacts on inflation, etc. So we do seem to be in a bit of a crisis point.
Yeah, we've mentioned again power prices in Europe, what they've done already to Germany, the car industry, steel industry.
So to see them going back up is not news that any European policymakers will want to hear.
For sure. Moving on, copper also sits on key support. Copper, a key component of industrial production. You can see the support on the chart, multi-year trend line. Again, technical traders will be looking at that. It's bouncing. It's just holding the support for now. Again, dollar strength isn't going to help that. Dollar strength is going to hurt commodity demand, full stop, particularly in emerging markets. But that's certainly one chart to keep an eye on. Again, similar to oil, volatility is getting lower. Expect to see a break in the coming weeks. Bitcoin is also bouncing. It's trading this morning at $99,000. What I've done here is brought in a chart showing the correlation with the S&P. Is it trading as an own separate asset class, or is it trading part of the whole risk on, risk off? Especially if you look very closely, the last 2 to 3 weeks, you see a similar sort of head and shoulders pattern. But again, we'll see how this plays out when Donald Trump takes office and how the markets react to that.
And then, one of the favorite charts that we love to look at is Aussie Kiwi dollars. And I think it's important, it's going to be something we'll look at for the year upcoming. But so just have a bit of a look at the Australian economy. It seems as though we're getting some quite mixed signals out of Australia, because there is some good news, being that pension funds in Australia, which is a growing industry, they've had double-digit returns in 2024. So these are pension funds that will typically look in global shares and be buying into global equities, etc. And they've been doing fantastically, which isn't a bad thing at all for the Australian economy. But what a lot of people are saying, so there was the Bloomberg headline coming out this week that the ASX 200, so the Australian stock benchmarks, this is going to be really lagging behind a lot of the Asia Pacific, the region overall. So there's uncertainty around the central bank's timelines. They've been quite sluggish in terms of cutting rates in comparison, particularly in comparison to New Zealand, of course, but in comparison to large parts of the rest of the world, they've been quite slow. And obviously one of their key trading partners, China, there's a lot of uncertainty about the Chinese economy at the moment. So I think a lot of speculators are slightly worried about Australia's equities going forward into 2025.
Yeah. Of course, on that, New Zealand did hike much more aggressively on the way up.
Yeah.
But they're cutting very aggressively on the way down. The chart there, the ASX 200, you can see it's clearly still an uptrend. You can see where the trend line support comes in. And again, if that breaks, then clearly it's a downtrend. But equities have been an uptrend for several years now, really since the COVID lows. But previous to COVID, it was since the financial crisis.
Absolutely. I suppose the interesting point of this is the impact upon things like, the foreign currency markets, because if equities are going up everywhere, but they're lagging behind slightly in Australia, that's going to have an impact on Forex, etc.
Yeah, also interest rate differentials, you say, with the central bank so active at the moment.
Totally.
And while we're looking at other international economies, India as well, the Sensex had a huge uprun, but that peaked on the 27th of September. Again, you can see from the trend line, it's still clearly in an uptrend, but we're now over 3 months from the peak, and you can see where the clear risk is. If the trend line breaks, we see lower lows. A similar pattern to an earlier peak with the S&P. Again, will risk resume with a new Trump presidency, or will we see some risk off and flight to quality? What concerns me with the Indian economy is the fact that currency is so weak. Currencies are all-time lows against the dollar. That, to me, is not a good signal, especially if you've got to buy commodities.
No, absolutely. And ultimately, if the economy has been doing so well because of a weak exchange rate, things have automatic stabilizers that sort of come in to some degree. So if exports are that competitive, then they get bought up. And then, of course, you see an appreciation. I suspect that if the rupee remains as cheap as it is, then you're either going to see further success in Indian exports, but realistically, I think we're going to be seeing some slightly worrying signs coming out of the Indian economy going into 2025.
And potentially inflationary risks as well from the imports. So central bank pricing for the next 12 months. Well, the market's pricing just 43 basis points of cuts from the Fed. As we said, we think they'll just sit on their hands and see how the next few months play out with the new presidency. ECB pricing 105, so 4 cuts from the ECB. What's more interesting here, the terminal rate for Fed funds, the market's pricing at 3.89. For Eurozone, 1.86. So again, similar to what we're looking at GDP expectations, the market's looking for a pretty big divergence in central bank movements. The Bank of England, just 2 cuts priced in, but actually a terminal rate there of the base rate is 4.12%. And we're starting to see signs of the economy weakening. If we think if there's an outlier there, if any, then it's more likely to be the Bank of England having to cut more aggressively. We're seeing some inflationary pressures, but if the economy weakens, that would unwind the inflationary pressures pretty quick. New Zealand, as we just mentioned, still another 129 basis points of cuts priced in, as opposed to just 80 from the RBA who have been sitting on their hands for so long.
That's where the uncertainty comes from, isn't it?
Yeah. Perhaps most interesting ones, the Bank of Japan, the market's pricing 47 basis points of hikes. Terminal rate at the end of the year would be at 70 basis points. That was the peak back in 2006 and 1996. So the market's saying rates are going to go back up to the highest level they've been since 1996, which is interesting. And what that would do with other central banks cutting rates, well, that would put pressure on the yen crosses. So you'd look to see yen strengthening. So perhaps there's trades there with sterling yen to the downside. And euro yen amongst others. On Friday, we have payrolls, the key economic data. Markets expecting 160,000 jobs created last month and unemployment to remain at 4.2%. But what we have seen recently is the hiring rate has plummeted. So that we'd expect that to see some downward pressure on payrolls. And of course, as we go through the year, we'd expect to see the US government hiring less aggressively, the Elon Musk and the Doge department being far stricter on hiring plans. On a final chart, I brought in Apple. Apple had a particularly weak, poor week start to the year last week. It's important, Apple, because it's the biggest weighting in the S&P. Apple accounts for 7.6% of the S&P 500 weightings. And from the chart here, you can see where the previous double top was. That would act as support at $237. Again, the very short term, it's trending down, but medium to long term, you'd say it's an uptrend. But again, if, and it may not happen, but if we get a close below 237, then you're going to start to see some significant unwinding in what is the biggest component of the S&P. And of course, that has risk because the S&P ETF is by far the biggest ETF with passive investing. So moving on to this week's data. On Tuesday in the US, we have ISM Services and the JOLTS Job Openings Index. Wednesday, ADP payrolls. It's not given that much significance. It doesn't correlate that well with US payrolls on Friday, but the market still does look at it. FOMC minutes and Eurozone PPI. Thursday, jobless claims and Eurozone retail sales. And then Friday, the big one for the market focus, the first of the year, US payrolls, but we also have consumer sentiment and of course also Canadian employment. Big week in Canada as well, with talk of Trudeau possibly resigning.
Yeah.
So that's the first macro Mondays of the year. Lots going on with the Trump presidency, lots of big data this week. Good luck. Please do post your thoughts and we'll see you next week.
Thank you very much.